So we went through that whole stack of sources you sent, over market reports, consumer trend analysis, even some notes on AI labor. And the picture they paint is, well, it's just fascinating. Our mission today is to take all that and really unpack this powerful paradox that's defining the economy right now.
It really is. It's a study in contradictions. On one hand, your sources are showing this extreme, almost giddy optimism in the financial markets. The investment class is acting like Christmas came early. That's the Santa Claus rally we're hearing
That's it.
about.
But running right alongside that, you have this deep sense of consumer restraint. People are not just tightening their belts, they are actively, and I mean aggressively, seeking out cheaper alternatives for everyday stuff. We're calling it the dupe economy.
And that's the core tension, isn't it? How can the stock market be looking at all-time highs, pricing in all this massive corporate success, while the consumer, who's supposed to be fueling it, is hyper-focused on finding the cheapest possible version of everything?
So we really have to understand these two separate tracks. One is all about financial liquidity, the promise of cheaper capital, and the other is driven by consumers practicing what the source is called selective austerity. They're choosing exactly where to be frugal.
And that choice, that strategic frugality, has huge implications, not just for retail, but for which investment sectors are really set to do well in the next few years.
Okay, let's unpack this. We should start with the engine of that optimism, that huge market boost. The immediate driver, the big one, is the Federal Reserve. We're talking about the third rate cut in this cycle, right? Setting the range at, what, 3.50 to 3.75%?
That cut was like pouring high-octane fuel onto an already eager market. Analysts immediately called the reaction liquidity optimism.
Yeah.
And it's global, too. It's not just the S&P 500. You saw indices like India Sensex and Nifty rally pretty significantly, just extending this whole year-end trend.
Now, the average person hears rate cut and, they think about their mortgage or a credit card. But why does this decision have such a dramatic effect on how companies are valued?
Because at their core, corporations are highly leveraged. I mean, their profit calculations always involve paying back debt. So when the base rate for borrowing goes down, the future cost of servicing their debt, the debt they already have or the debt they plan to take on to expand, it just drops significantly.
So just because the cost of their debt is lower, their bottom line, their profitability, it goes up automatically without them selling one extra product.
Precisely. The market isn't just reacting to the current quarter's numbers. It's pricing in a future where capital is cheaper. It raises the net present value of all those future corporate earnings. So investors push up valuations across the board because they expect higher future profits, simply from cheaper money. It's a fundamental mechanical adjustment. That's the justification for the rally.
But it's not lifting every single ship, is it? The rally isn't universal. The material you sent shows the enthusiasm is actually pretty selective, especially when you look at the big tech names.
That's a crucial counterpoint.
Yeah.
We saw a really clear reality check with the revenue disappointment from Oracle. That news just injected a dose of what you could call AI-related pessimism into the whole story. It briefly dragged down some of the big chip names that were banking on massive speculative spending on AI infrastructure.
And that's where the whole market thesis just seemed to evolve overnight. It pivoted from this broad, almost lazy mindset of if it has AI in the name, buy it, to something much more rigorous. It became only buy the AI companies that are showing real, immediate, measurable revenue right now.
Exactly. And this is why you're seeing institutional money, the smart money, rotating towards what are seen as safer, more integrated bets. Look at Microsoft or Broadcom. These companies aren't just relying on some speculative future adoption of AI. Their AI impact is already deeply baked into existing enterprise software, cloud services, and hardware. It's visible, it generates revenue, and it's defensible.
Okay, so if some of that speculative tech growth is losing steam, where's the serious value hunting taking investors? This brings us right to the sector rotation that's happening outside of Silicon Valley.
Well, if you're an institutional investor, you're looking for things that are fundamentally cheap today, but have a clear, high-potential return once the long-term rate environment really settles. And that puts real estate investment trusts, or REITs, right at the top of that list.
Why REITs? I mean, to the average person, commercial real estate still feels a bit shaky after the last few years of rate hikes.
And that's exactly why they're undervalued. The sources estimate the sector is trading at around a 10% discount right now. The logic is that REITs are debt-heavy, they're constantly borrowing money to buy or develop properties, and their profits are tied so closely to the valuation of those assets.
So the higher rates were there.
They're kryptonite.
Exactly.
But now, analysts are forecasting significantly lower long-term rates by 2026. If the Fed follows through on that path, it gives REITs this massive double tailwind. First, their debt costs plummet, which instantly boosts their income. And second, lower long-term rates just generally make property assets themselves more valuable. When you see tickers like Realty Income or Crown Castle getting mentioned, it's a signal. It shows where big funds are betting on this future debt relief. They're buying today's discount.
That's a masterclass in buying the future discount. And it's not just physical assets. The sources also point to energy as another rotation target, which is surprising given the global push for renewables.
It is surprising, but the math is pretty compelling. Despite the, notorious volatility of oil prices, a lot of exploration, production, and service stocks in the energy sector are just seen as deeply undervalued. We're talking discounts of up to 30% relative to their fair value, just based on current cash flow and assets. Even with fluctuating oil prices, the businesses are a bargain.
Okay, so we have this financially optimized, Fed-fueled market selectively betting on integrated tech and rotational value in these deep discounted sectors. Now we have to pivot hard. Let's look at the customer who's supposed to be paying the prices that keep those profits up. This is the dupe economy. Where is this cultural shift coming from?
This is where the story gets really textured.
Yeah.
And it perfectly explains that split screen we talked about. We're looking at Gen Z and younger millennials, the biggest consumer group, and they aren't spending less overall. What they are doing is practicing extreme financial segmentation. They're spending selectively, strategically.
Let's get specific. Where are they applying the austerity, and what does a dupe actually mean in practice?
The austerity is hitting the unglamorous things, the core expenses. Dining out is one of the biggest cuts. Basic clothing is another. A dupe short for duplicate is an actively sought out, much cheaper alternative that does the same thing or gives the same look as a popular brand name product.
So instead of the $80 premium skincare that's trending, they'll find a $15 alternative with the same active ingredients.
That's it, exactly. And this is all supercharged by social media.
Yeah.
It's almost a badge of honor to find a dupe that performs just as well. They're maximizing efficiency on the things they have to buy so they have money left over for the things that signal who they are.
Which brings us to this fascinating new lipstick effect. In the past, people would buy lipstick in a downturn because it was a small luxury they could afford. How is that different today?
It's become a hyper-visual, identity-driven splurge. The money they save by buying that dupe, that selective austerity, it gets immediately reallocated into highly visible, culturally meaningful indulgences.
What are we talking about here? The splashy buys.
We're talking about things that give instant status or identity. Premium, high-end cosmetics, the items that are essential for their digital presence. High-end coffee, like an $8 artisanal matcha latte. Or maybe an exclusive pair of resale sneakers. The consumer's basically signaling, I'm responsible with my core spending, but I'm successful and relevant enough to afford these specific visible luxuries.
It's a brilliant insight into how modern status works. The savings don't go into a bank account, they fuel a social identity. And speaking of how status and spending work, the place where consumers find these products is changing everything. We have to talk about the evolution of the digital mall. Platforms like TikTok Shop.
The sources show TikTok Shop isn't just for discovery anymore. It is a direct transaction engine. And the speed of its growth is just revolutionary. It's projected to exceed, $15 billion in U.S. merchandise value next year in 2025. The trajectory is staggering.
And the data we saw suggests it's already surpassing major established retailers like Sephora and Ulta in transaction volume for certain categories.
That statistic right there is the bellwether. It confirms the creator economy, the influencers, the short-form video reviewers. It's no longer just marketing for commerce. It is commerce. The takeaway for brands is this. If you can instantly translate a viral trend to a physical shelf, you're going to dominate. The transaction happens milliseconds after the influence.
This whole shift, this blend of austerity and visibility, it forces us to look beyond the next quarter and into the high-growth industry shaping 2026 and beyond. The sources pointed to two really unexpected areas.
The first is longevity and GLP-1 medications. This is not just a pharma story, it's a huge societal shift. The abstract goal of living longer has been replaced by the very tangible demand of feeling better right now.
And the market saturation is already intense, which makes it impossible to ignore. The research says over 30 million U.S. households have a GLP-1 user, so medications like Ozempic or Mounjaro. That scale, It means this trend is hitting everything from food supply chains to elective surgery.
Absolutely. When you see a demographic shift that large, investment just pours into the whole ecosystem around it. And we're seeing huge growth in specialized health tech, diagnostics, wellness products tailored to this group, digital platforms for managing conditions. For entrepreneurs and planners, this isn't just a drug trend. It's a complete repositioning of consumer health spending.
And the second area, that unexpected new side hustle for 2026, is AI-driven content humanization. This is really where the pendulum swings back toward the need for human input.
Well, as generative AI becomes fully mainstream, producing mountains of text, scripts, video, a very clear and urgent need for human correction has emerged. There's a massive surge in demand for people to step in and clean up that AI-generated output.
What does cleaning up or humanizing even mean? Isn't the AI supposed to handle that?
AI is great at efficiency. It's terrible at subtle authenticity. The sources explain this labor is crucial for brands that need their output to align with specific values or regional nuances or just genuine emotion. If a video or a text had that slightly sterile, off-kilter AI feel, the jokes don't quite land or the emotional tone is unconvincing, it actively pushes consumers away. So humans are now being paid a premium to inject the slang, the empathy, and the cultural references that make a brand's message feel real.
That's a powerful feedback loop. Efficiency creates a brand new demand for authenticity. So we've connected these two parallel universes. The financial markets are optimizing for profits with cheap capital, hunting for deep value in discounted sectors like real estate and energy.
And at the same time, the consumer is doing this sophisticated triage on their budget, using the dupe economy to fund high-status, culturally relevant splurges, and moving their spending to new, faster platforms like TikTok Shop.
The value for you, the listener, is in seeing that these two worlds, while they seem contradictory, are both highly intelligent. The market is smart in its liquidity bets, and the consumer is smart in their strategic spending. So you need to understand the mechanics driving value in sectors like REITs and energy, and also the cultural forces fueling growth in areas like GLP-1 wellness and content humanization.
It creates this fascinating picture of a very strategic but extremely fragmented economy.
And that leads us to our final provocative thought for you to consider as we wrap up this deep dive. If market stability relies so heavily on corporate profits, which often come from squeezing out cost savings and efficiency, yet the consumer is actively signaling that they're prioritizing identity and micro splurges over buying those core goods at premium prices. What does the selective, identity-driven nature of the dupe economy suggest about the long-term sustainability of that broader Fed-fueled rally? What stands out to you?